Hey friends, welcome back to the channel. In this video, we're going to talk about how much housing you can actually afford based on your salary. Both home prices and rent prices have been skyrocketing in the past 2 years, and this is mainly due to rising interest rates. The median salary in the United States is currently $59,428, with an average home price of $410,000. In this current environment, it's harder than ever to buy a home, and for this reason, it's also easier than ever to make a bad financial decision. If you're a new home buyer, there are a couple of finance rules that might help guide you in the home buying process. These rules were created in 2007-2008 when there was a housing market crash. The three rules that we're going to go over are the rule of 28 and 36, the rule of 30-33, and the 45 and 49 rule. After we go over the rules, we'll also look at a couple of salary ranges and put these rules into practice. And just as a friendly reminder, this is not financial advice, it's for educational purposes only. What is the rule of 28 and 36? As a new home buyer, the first question you have to ask yourself is whether or not you'll qualify for a home mortgage in the first place. A home is a very large purchase, but banks are very eager to give you the mortgage in the first place. After all, it's a part of their core business philosophy. On the other hand, as a lender, they are taking some risk on, namely the default risk. There's two main criteria in which banks will use to evaluate potential home buyers. There's your credit score and there's your debt to income ratio, also known as DTI. Your credit score is self-explanatory. It's essentially a report card of how good of a borrower you have been in the past couple of years. Your debt to income ratio, on the other hand, represents a current snapshot of your financial standing and how it might project into the future. The calculations for DTI are very simple. You take all of your debt obligations on a monthly basis and you divide it by your gross salary on a monthly basis. The 28 just stands for the maximum allocation of your gross salary towards your housing payments. Let's use an example salary of $100,000. In this case, you could allocate up to $28,000 on an annual basis towards housing. And on a monthly basis, that comes out to $2,333. The second part of the rule, the 36, takes into account all of your other debt obligations as well. Let's assume you have a $500 student loan payment and a $300 car payment. This means you have an additional $800 in debt obligations in addition to the mortgage that you would be paying. And when you combine all of these debt obligations, those should all be under 36% of your gross annual salary. Let's put the rule of 36 into practice. Using the same salary of $100,000, in this case, you could allocate $36,000 towards all of your debt obligations. On a monthly basis, that's $3,000. In order to calculate your maximum mortgage, you subtract out the $500 student loan payment, the $300 car payment, and now you're left with $2,200 to go towards your housing payments. As you can see here, your other debt obligations really impact how much house you could qualify for and how much house you can actually afford. And just to put this into perspective, banks were much more strict sticking to this 28 and 36 rule back when interest rates were low. But now that interest rates are rising, they're willing to give up to 45 to 50% on home mortgages. That doesn't mean it's a good financial decision though. You still need to decide whether it makes sense. Ultimately, this rule is meant to protect you as the home buyer, not the banks. At the end of the day, it's your decision on how conservative or aggressive you want to be in the home buying process. Let's move on to the sister rule, the rule of 30-33. The first part of the rule you're already familiar with. The 30 stands for the maximum percentage of gross salary you should allocate towards housing. The second 30 refers to the down payment. It encourages you to have 30% of the home value in cash before purchasing the home. 20% will go towards the down payment, and the other 10% will go towards your closing costs and also any other miscellaneous repairs that you might have as soon as you buy the home. The last thing you want to do is use up all of your free cash and then not have any cash left over for all of the other expenses as a new home buyer. And the last part of the rule, the 3, stands for 3x your gross salary. This represents the maximum house you should think about purchasing based on this rule. Let's put these rules into action. If you have a $100,000 salary, then your maximum house should be around $300,000. Your maximum monthly payment should be around $2,500. And ideally, you'd have $90,000 saved up as a deposit and your other closing costs. Now, I know what you're going to say next. This is near impossible. The average salary in the United States is $59,000 and the average home price is $410,000. That's almost 8x. If you allow me to play devil's advocate for a moment though, this is exactly why the rules were invented in the first place. In 2009, buyers were too eager and they were taking on more mortgages than they could handle. They also assumed that they could refinance their mortgage rates when interest rates came down, But as home prices crashed, they were unable to do so because the value of their home also went down. This is why the 30-30-30 rule is created in the first place. If 30% of your income is going towards housing, you do have some wiggle room in case payments were to go up. In addition, you already have 30% equity in your home, so you have some wiggle room even if your house were to depreciate in value. And lastly, the 3x means that you're not extending yourself and buying more of a home that you can't afford. I know this might seem like a little bit of a Debbie Downer, but honestly, there is hope. If you're able to pay off your other debt obligations like your student loans, car payments, and credit card payments, you can start saving up for a deposit on your home. If you want to learn more about how I paid $200,000 of student loan debt in just 18 months, you can check out my other video here. What is the rule of 45? This rule is actually very similar to the 28 and 36 rule, and it's the most lenient of all. It essentially states the maximum loan that a bank is willing to give you towards a home. So if you're making $100,000 on an annual basis, theoretically, they would lend you up to $45,000 on an annual basis or $38.75 on a monthly basis. This by far is the most aggressive home buying rule, and it's not recommended for most people, especially in high interest rate environments. The main problem with this rule is that you're over leveraged. If anything were to change in your financial picture, such as new debt obligations or a decrease in salary, now you run the risk of being underwater on your mortgage. There's essentially no leeway at all. For the next section, let's take a look at some example salary ranges and put these rules into action. Also, I'll use an online calculator and you can follow along so it'll be easier to go over. Given that the annual salary in the United States is around $59,000, I'm going to use a dual income of $120,000 for these calculations. So first, let's plug in the annual income of $120,000. Next, let's say they still have some student loans and their monthly debt obligations is around $1,000. They don't have a down payment yet as they haven't saved up any money. And let's assume that they want to use the lowest DTI to be the most conservative. In this case, a dual income family with $120,000 who still has student loan obligations and wants to be very conservative, their maximum home buying is $179,000. Now, let's see what happens if we change this monthly debt obligation. If we cut the monthly debt obligation in half, now your home goes from $179,000 to $238,000. And let's assume that you completely eliminate the debt. Now it goes from $238,000 all the way up to $297,000. As you can see, just by paying your student loan down, you can increase your buying power by 50%. And now that student loans are paid off, let's say they want to be a little bit more aggressive and are willing to go up to 32% DTI. As you change the 26 to 32, your home price goes from $297,000 all the way up to $368,000. This still assumes you have a zero deposit. So just by paying off your student loans, you went from $179,000 all the way up to $368,000. Let's see what would happen if they're able to save up for a deposit as well. Let's say that your down payment goes all the way up to $50,000. Now, all of a sudden, your housing affordability goes all the way up to $424,000. We've finally become competitive and caught up to meeting home prices on a national basis. And if we apply that gold standard of the 30-30-30 rule, we're not exactly there, but we're very close. Your house price compared to your annual income is 4x. Your down payment is only 10%, something we can improve on. And your DTI that you're using is 32%, close to that 30% benchmark. And lastly, let's use the most aggressive estimate of 45% and see what the very tail end of housing would be. In this case, we change this 32 to 45, and now we're left with $573,000. This is the most aggressive that someone with a $120,000 annual salary should be using. They will qualify, but again, it doesn't mean that it's necessarily a good idea. Overall, someone with a $120,000 salary, their housing affordability will range anywhere between $179,000 and $573,000. The key takeaway here is your monthly debt obligation and your down payment, they significantly impact how much house you can be pre-approved for and actually afford. And if you're still not sure whether you want to buy or rent in 2024, just know that you're in good company and it's not an easy decision. You should always run the numbers for yourself and see if it makes sense to continue renting and saving up a bigger deposit. If you want a closer look at the buying versus rent argument, I made another video here where I go over all of the calculations. Anyways, I hope you have a great day, guys. I'll see you next time. Peace.